Hello, in this lecture we're going to work some test type problems, smaller type problems that could fit into the format of multiple choice questions. We have here, a corporation issued 250 shares of its $5 par value common stock in payment of a $3,300 charge from its accountant for assistance in filing its charter with the state. The entry to record this transaction will be what? So in this case, we're going to kind of have to interpret what's going on here. What happened is it looks like we had an accountant do some transaction for us and then send us an invoice, the invoice being for $3,300. Instead of paying cash for that invoice, $3,300 check, we are going to issue stock. We decided on 250 shares at $5 par. What does that mean to us? It means that the 250 shares we're assuming has a market value of $3,300 because we're going to exchange for that value. So the bill was for that much. If we're assuming that we're going to pay 250 in shares, then the 250 shares must be equal to the 3,300 price. Now you might be saying, well, where does the $5 par value work into that then? Remember that the $5 par value does not represent the market value of the stock. It's just an arbitrary number so that we have a standard set number for all shares of stock when we see it on the financial statement. So let's see what this would look like. If we got a bill from the accountant, it might be going to accounting expense or legal and professional expense. Some kind of expense account is going to go in here. That's going to be the debit for $3,300. That's the bill we got. Then we're going to issue the common stock. I'm just going to say common stock is going to be issued. Now we issue it at just the standard par value. So we're going to say, I'm going to make it a negative to make the credits negative. It's going to be the 250 times 5. That's what we're going to issue. Now, of course, the debits do not equal the credits here because, once again, that 250 times 5 just an arbitrary number that we're going to issue the stocks for, and we got to put the difference into an account called additional paid in capital. So I'm not going to type it all out, but it's additional paid in capital. And so we're going to say that's going to be the plug. 3,003 minus the 1,250 means we have an excess of additional paid in capital of 2,050. I'm going to do that with the negative sum function, meaning I'm going to say negative instead of equals, SUM, summing this up, this number minus this number plus that negative number, and then flip the sign. That's why we put a negative in front of it, and that means that this minus this equals 0, or the credits here equal the debits there, and that's what we have. So remember, when we issue the stock, we're going to issue it at the par value, and then put the difference in the additional paid in capital. So really the common stock and the additional paid in capital is the investment that has been input. Next one says that prior to May 1st, company has never had any treasury stock transaction. A company purchased 280 shares of its common stock on May 1st. So we purchased our own stock, that's treasury stock, for $14,000. On July 1st, it reissued 140 of these shares for $52 per share. On August 1st, it reissued the remaining treasury stock at $49 per share. What is the balance in the paid in capital treasury stock account at August 2nd? Okay, so when we first bought it back, it's going to be treasury stock that we purchased back. And even though it's in the equity section, it's kind of like another asset. We treat it almost as if we purchased another company, meaning we're going to put it on there as a debit, but not in the asset section, in the equity section, and we paid $14,000 for it, and we're going to credit cash just like if we purchased someone else's stock. Now what we have to do is track that. We got to say, okay, well, what does it cost per share then if we purchased our own stock back at that time? We're going to say that the number of shares for treasury stock shares is going to be we purchased 280 shares for a total cost. I'm going to put this over here. A total cost of $14,000. Therefore, the cost per share is going to be dividing those. 14,000 divided by 280 would then be the cost we paid per share. So we're going to kind of figure that out. It's going to be the 14,000 divided by the 280. That means it costs $50 per share. So just like when we sell any other type of share, we're going to have to figure out, okay, well, if we sell it, we're going to sell it for whatever the market price is. Could be greater or less than this $50 per share. We generally put the difference into this treasury stock, the paid in capital for the treasury stock. So that's what we need to track now. So the first thing that happens, or the next thing that happens, on July 1st, we reissued 140. So we resold our treasury stock, which we purchased, and now we're putting it back on the market. We're going to get cash for that sale. We sold it for 52, even though we bought it for 50. So we kind of have like a gain, but since it's on our own stock, it's all going to be in the equity section. We're not going to put a gain to it, so we're going to say this equals, the cash is going to be 140 times $52 per share. We got 7,280. And then we're going to credit the treasury stock to take that off the books, but we're going to take it off the books at the $50 because that's the cost that we bought it for. So we're going to say this is, I'm going to say it's a negative, just to make it a negative 50 times 140 shares that we sold, and that comes up to 7,000. And of course, 7,000 minus the 7,280 means that we need 280 on the credit to make our debits equal the credits. So I'm going to say this is the negative sum of these, which means this plus that negative, which is a subtraction problem. Flip the sign so that our credits equal to 7,280, which equals the debits. Now, if this was a normal stock sale, we would put that into a gain, meaning we got more cash than we purchased it for. But since it's treasury stock, it's all in the equity section. This is what is going to be, we're going to call this paid in capital treasury account. So I'm just going to copy and paste that here. That's going to be the credit. And that's what we're kind of trying to track. So I'll paste that here too. That's going to be, whoop, that's not what I wanted to do. I just want to paste it normal. And we'll make our T account here like this as well. So I'm just going to make a T account and say that we're going to underline this and put the T here. And where's my left? All right. And so we have this in here at this point, the 280. And then, of course, we have another activity that happens. We sold the rest of the treasury stock on August 1st. It reissued the remaining 49 per share. What is the balance in the paid in treasury stock at August 2nd? So the next one, we said cash. Now we've got another 140 shares we sold, but now we sold it for $49, even though we purchased it for 50. So times 49. And then we're going to take the treasury stock off the books for that 140 times 50, because that's what we bought it for. And then again, we're going to have this account paid in capital, which is going to be the plug. In this case, it's got to be a debit though. And I know I have my debits and credits not in perfect order, but we're going to do it this way because it's quick. So now my debits equal the credits, 7,000, 7,000. And obviously, and if it was someone else's stock, that would be a loss. In this case, again, it's going to go into that paid in capital. So now we have a debit in the paid in capital. Credits are still winning, so the balance in the paid in capital at this point would equal the debits minus the credits. Credits are winning by the 1,040. So that's what we have there. We can go ahead and do our double underline thing here, and that's what we have in the paid in capital treasury stock. Next one says that a company paid 60 cents in cash dividends per share. Its earnings per share is $4.32 and its market price is $28.50. So its cash dividend yield is what? So when we talk about the dividend yield, what we're comparing, it's going to be a ratio. Many of these kind of estimations of value are going to be ratios. We're going to compare the amount of dividends we got compared to the market price. So we're going to say the dividends paid, we got the dividends are 0.6, and I'm going to go ahead and add decimals to all of these because we're going to need to see some decimals, some pennies here. So we got 0.6, and we're not talking about the earnings per share in this case, we're talking about the amount that we actually got paid in dividends. The earnings, we can't take that out because as a stockholder, we can't take out the earnings. So we could still do calculations on the earnings per share, but what we're talking about in this particular calculation is the actually cold cash that we actually got received from the company in the form of dividends. So we got the 0.6 and then we got the market price. Market price being 28.5, and if we divide those out, I'm going to underline, home tab, font, underline. And then we're going to say it's the 0.6, 60 cents, divided by the 28.50. And that gives us 0.02. We're going to make that a percent. So we're going to go to the home tab, numbers, percentize it, and then add a couple decimals. So it's 2.11%. That would be the dividend yield.